Good morning, good afternoon, and good evening, folks. Today we will talk about Chapter 10, Part 2. Thank you for listening to my channel, and I appreciate that. Let's begin. Clearly, the internet bubble of the 1999, early 2000 period provides a classic example of incorrect investment judgments leading people to go mad in herds. Individual investors, excited by the prospect of huge gains from stocks catering to the new economy, got infected with an unreasoning herd mentality. Word-of-mouth communications from friends at the golf club, associates at work, and fellow card players provided a powerful message that great wealth was being created by the growth of the internet. Investors then began to purchase common stocks for no other reason than that prices were rising and other people were making money, even if the price increases could not be justifiable by fundamental reasons such as the growth of earnings and dividends. As the economic historian Charles Kindleberger has stated, "There is nothing so disturbing to one's well-being and judgment as to see a friend get rich." And as Robert Schiller, author of the best-selling Irrational Exuberance, has noted, the process feeds on itself in a positive feedback loop. The initial price rise encourages more people to buy, which in turn produces greater profits and induces a larger and larger group of participants. The phenomenon is another example of the Ponzi scheme that I described in Chapter 4, in connection with the internet bubble. Eventually one runs out of greater fools. Such herding is not limited to unsophisticated individual investors. Mutual fund managers have a tendency to follow the same strategies and herd into the same stocks. Indeed, a study by Harrison Hong, Jeffrey Kubik, and Jeremy Stein, three leaders in the field of behavioral finance, determined that mutual fund managers were more likely to hold similar stocks if other managers in the same city were holding similar portfolios. Such results are consistent with an epidemic model, in which investors quickly and irreversibly spread information about stocks by word of mouth. Such herding has had devastating effects for the individual investor. Although long-run returns from the stock market have been generous, the returns for the average investor have been significantly poorer. This is because investors tended to buy equity mutual funds just when exuberance had led to market peaks. During the 12 months ending in March of 2000, more new cash flow went into equity mutual funds than during any preceding period. But while the market was reaching troughs in the falls of 2002 and 2008, individuals made significant withdrawals from their equity investments. A study by Dalbar Associates suggests that the average investor may earn a rate of return 5 percentage points lower than the average market return because of this timing penalty. In addition, investors tend to put their money into the kinds of mutual funds that have recently had good performance. For example, the large inflows into equity mutual funds in the first quarter of 2000 went entirely into high-tech, growth funds. So-called value funds experienced large fund outflows. Over the subsequent 2 years, the growth funds declined sharply in value, while the value funds actually produced positive returns. This selection penalty exacerbates the timing penalty described above. One of the most important lessons of behavioral finance is that individual investors must avoid being carried away by herd behavior. Loss aversion Kahneman and Tversky's most important contribution is called prospect theory, which describes individual behavior in the face of risky situations where there are prospects of gains and losses. In general, financial economists such as Harry Markowitz constructed models where individuals made decisions based on the likely effect of those choices on the person's final wealth. Prospect theory challenges that assumption. People's choices are motivated instead by the values they assign to gains and losses. Losses are considered far more undesirable than equivalent gains are desirable. Moreover, the language used to present the possible gains and losses will influence the final decision that is made. In psychological terms, this is known as how the choice is framed. For example, you are told that a fair coin will be flipped and that if it comes up heads you will be given $100. If the coin comes up tails, however, you must pay $100. Would you accept such a gamble? Most people would say no, even though the gamble is a fair one in the sense that in repeated trials you would end up even. Half the time you would gain $100 and half the time you would lose $100. In mathematical terms, the gamble has an expected value of 0, calculated as follows. Probability of heads times payoff if heads plus probability of tails times payoff if tails equals expected value. Expected value equals $1/2, $100, plus $1/2, $100, equals 0. Kahneman and Tversky then tried this experiment with many different subjects, varying the amount of the positive payoff to test what it would take to induce people to accept the gamble. They found that the positive payoff had to be about $250. Note that the expected value of the gain from such a gamble is $75, so this is a very favorable bet. Expected value equals $1/2, $250, plus $1/2, $100, equals $75. Kahneman and Tversky concluded that losses were 2.5 times as undesirable as equivalent gains were desirable. In other words, a dollar loss is 2.5 times as painful as a dollar gain is pleasurable. People exhibit extreme loss aversion, even though a change of $100 of wealth would hardly be noticed for most people with substantial assets. We'll see later how loss aversion leads many investors to make costly mistakes. Interestingly, however, when individuals faced a situation where sure losses were involved, the psychologists found that they were overwhelmingly likely to take the gamble. Consider the following two alternatives. 1. A sure loss of $750. 2. A 75% chance to lose $1,000 and a 25% chance to lose nothing. Note that the expected values of the two alternatives are the same, that is, a loss of $750. But almost 90% of the subjects tested chose alternative 2, the gamble. In the face of sure losses, people seem to exhibit risk-seeking behavior. Kahneman and Tversky also discovered a related and important framing effect. The way choices are framed to the decision maker can lead to quite different outcomes. They posed the following problem. Imagine that the U.S. is preparing for the outbreak of an unusual Asian disease, which is expected to kill 600 people. 2 alternative programs to combat the disease have been proposed. Assume that the exact scientific estimates of the consequences of the programs are as follows. If Program A is adopted, 200 people will be saved. If Program B is adopted, there is a 1/3 probability that 600 people will be saved and a 2/3 probability that no people will be saved. Note first that the expected value of the number of people saved is the same 200 in both programs. But according to prospect theory, people are risk-averse when considering possible gains from the 2 programs, and, as expected, about 2/3 of the respondents to this question picked Program A as the more desirable. But suppose we framed the problem differently. If Program A** is adopted, 400 people will die. If Program B** is adopted, there is a 1/3 probability that nobody will die and a 2/3 probability that 600 people will die. Note that the options A and A** as well as B and B** are identical. But the presentation in the second problem is in terms of the risks of people's dying. When the problem was framed in this way, over 75% of the subjects chose Program B**. This illustrated the effect of framing, as well as risk-seeking preferences in the domain of losses. When doctors are faced with decisions regarding treatment options for people with cancer, different choices tend to be made if the problem is stated in terms of survival probabilities rather than mortality probabilities. Pride and regret behavioralists also stress the importance of the emotions of pride and regret in influencing investor behavior. Investors find it very difficult to admit, even to themselves, that they have made a bad stock market decision. Feelings of regret may be amplified if such an admission had to be made to friends or a spouse. On the other hand, investors are usually quite proud to tell the world about their successful investments that produced large gains. Many investors may feel that if they hold on to a losing position, it will eventually recover and feelings of regret will be avoided. These emotions of pride and regret may be behind the tendency of investors to hold on to their losing positions and to sell their winners. The Barber and Odine study of the trading records of 10,000 clients of a large discount brokerage firm found a pronounced disposition effect. There was a clear disposition among investors to sell their winning stocks and to hold on to their losing investments. Selling a stock that has risen enables investors to realize profits and build their self-esteem. If they sold their losing stocks, they would realize the painful effects of regret and loss. This reluctance to take losses is clearly non-optimal according to rational investment theory and stupid in common-sense terms. Selling stocks with gains, outside tax-advantaged retirement accounts, involves paying capital gains taxes. Selling stock on which losses have been realized involves reducing taxes on other realized gains or a tax deduction, up to certain limits. Even if the investor believed that his losing stock would recover in the future, it would pay to sell the stock and purchase a stock in the same industry with similar prospects and risk characteristics. A similar reluctance to take losses appears to be evident in the residential housing market. When house prices are rising, the volume of sales rises and houses tend to sell quickly at asking prices or higher. During periods of falling prices, however, sales volumes decline and individuals let their homes sit on the market for long periods of time with asking prices well above market prices. Extreme loss aversion helps explain sellers' reluctance to sell their properties at a loss. Behavioral finance and savings. Behavioral finance theory also helps explain why many people refuse to join a 401k savings plan at work, even when their company matches their contributions. If one asks an employee who has become used to a particular level of take-home pay to increase his allocation to a retirement plan by $1, he will view the resulting deduction, even though it is less than $1 because contributions to retirement plans are deductible from taxable income up to certain generous amounts, as a loss of current spending availability. Individuals weigh these losses much more heavily than gains. When this loss aversion is coupled with the difficulty of exhibiting self-control, the ease of procrastinating, and the ease of making no changes, status quo bias, it becomes, as psychologists teach us, perfectly understandable why people tend to save too little. 2 suggestions have been made to overcome people's reluctance to save. The first is to overcome inertia and status quo bias by changing the framing of the choice. We know that if we ask employees actively to sign up for a 401k savings plan, many will decline to join. But if the problem is framed differently, so that one must actively opt out of the savings plan, participation rates will be much greater. Corporations that frame their 401k savings plans with an automatic enrollment feature, where a conscious decision must be made to fill out an opt-out declaration, have far higher participation rates than do plans where employees must actively opt in to the plan. Another brilliant enticement has been developed by the economists Richard Thaler and Shlomo Benartzi. Some employees will decline to save even with plans that have automatic enrollment because they can barely make ends meet with their current salary. The essence of the Thaler-Benartzi Save More Tomorrow plan is to have employees commit in advance to allocate a portion of any salary increases toward retirement savings. If employees join the plan, their contribution to their retirement savings plan is increased, beginning with the first paycheck after a raise. This feature mitigates the perceived loss aversion of a cut in take-home pay. The contribution rate continues to increase on each scheduled raise until it reaches the maximum tax-deductible amount allowed by law. In this way, inertia and status quo bias work toward keeping people in the plan. The employee is allowed to opt out of the plan at any time. Thaler and Benartzi first implemented their plan in 1998 at a mid-size manufacturing company. The company was suffering from low participation in its retirement savings. The limits to arbitrage. Thus far we have considered the cognitive biases that influence investors and, therefore, security prices. The actions of individual investors are often irrational, or at least not fully consistent with the economist's ideal of optimal decision-making. In perhaps the most pathological case, individuals appear to go mad in herds and bid some categories of stocks to unreasonable heights. Since the errors of irrational investors do not cancel out but often reinforce each other, how can stocks be efficiently priced? Believers in efficient markets rotely state that arbitrage will make the market efficient even if many individual investors are irrational. Arbitrageurs, such as professional Wall Street traders and hedge fund managers, are expected to take offsetting positions such as selling overpriced stocks short and buying underpriced ones so that any mispricing caused by irrational investors is quickly corrected. Rational traders are expected to offset the impact of behavioral traders. Thus, the second major pillar on which some behavioralists rest their case against efficient markets is that such arbitrage is severely constrained. Behavioralists believe that important limits to arbitrage exist that prevent out-of-whack prices from being corrected. Suppose irrational investors cause an oil company security to become overpriced relative to both its fundamental value and its peer oil companies. Arbitrageurs can simply sell the overpriced security short and buy a similar substitute oil company security. Thus, the arbitrager is hedged in the sense that favorable or unfavorable events affecting the oil industry will influence both companies. A rise in the price of oil that makes the shorted security rise will make the arbitrageur's long position rise as well. But this kind of arbitrage is extremely risky. Suppose the overpriced security reports some unusually good news, such as a significant oil strike that was not anticipated. Or suppose the fairly valued security suffers some unforeseen setback, such as the explosion of a deep-water oil well, which causes its price to fall. The arbitrager could conceivably lose on both sides of the trade. The security that had been sold short could rise, and the security held long could fall. The kind of arbitrage required to correct perceived mispricings is extremely risky. The trader who tries to correct perceived mispricings also runs the risk that investors will become even more overenthusiastic about the prospects for the overpriced security. Suppose an arbitrager was convinced during 1999 that internet stocks were outrageously overpriced. The trader might sell short the internet favorites, hoping to buy them back later at lower prices. But as enthusiasm for the new economy continued to grow, the prices of these stocks rose even further, many of them doubling, and then doubling again. Only in retrospect do we know that the bubble burst during 2000. In the meantime, many traders lost their shirts. The market can remain irrational longer than the arbitrager can remain solvent. This is especially true when the arbitrager is credit-constrained. Long-term capital management, a hedge fund in which Nobel laureates devised the strategies, found itself in an untenable position when the prices of its hedges moved against it, and it had insufficient capital to keep them afloat. The natural players in the game of selling overpriced securities short and buying underpriced ones are global hedge funds, with trillions of dollars to invest. One might suppose that these funds would have recognized the unsustainability of the prices of internet stocks and exploited the mispricing by selling short. A study by Marcus Brunnermeier and Stefan Nagel examined hedge fund behavior during the 1998 to 2000 period to see whether these funds restrained the rise in speculative favorites. The findings were surprising. Sophisticated speculators such as hedge funds were not a correcting force during the bubble period. They actually helped inflate the bubble by riding it rather than attacking it. Hedge funds were net buyers of internet stocks throughout the 1998, early 2000 period. Their strategy reflected their belief that contagious enthusiasm and herding of unsophisticated investors would cause the mispricing to grow. They were playing the game described earlier in Keynes's famous newspaper beauty contest. While a stock selling at $30 might be worth only $15, it would be a good buy if some greater fools would be willing to pay $60 for the stock at some future time. It appears that hedge funds also played a destabilizing role in the oil market during 2005 and 2006. From 2004 to 2006, the price of a barrel of crude oil more than doubled. Although economic forces such as the growth of the world economy provided some fundamental reasons for the upward price pressure, it seems that speculative activity, especially by hedge funds, helped fuel the advance. And the few hedge funds that went short in the oil futures market experienced substantial losses. It is clear that arbitrage trades to correct a perceived price bubble are inherently risky. And there are also times when short selling is not possible, or at least severely constrained. Typically, in selling short, the security that is shorted is borrowed in order to deliver it to the buyer. If, for example, I sell short 100 shares of IBM, I must borrow the securities to be able to deliver them to the buyer. I must also pay the buyer any dividends that are declared on the stock during the period I hold the short position. In some cases, it may be impossible to find stock to borrow, and thus it is technically impossible even to execute a short sale. In some of the most glaring examples of inefficient pricing, technical constraints on short selling prevented arbitrageurs from correcting the mispricing. Arbitrages may also be hard to establish if a close substitute for the overpriced security is hard to find. For an arbitrage to be effective, there must be a similar fairly priced security that can be bought to offset the short position, and that can be expected to rise if some favorable event occurs that influences the whole market or the sector to which the security belongs. One of the best examples used by behavioralists to show that market prices can be inefficient is the case of two identical shares that do not trade at identical prices. Royal Dutch Petroleum and Shell Transport are considered Siamese twin companies. These companies agreed in 1907 to form an alliance and to split their after-tax profits 60% for Royal Dutch, 40% for Shell. In an efficient market, the market value of Royal Dutch should always be 1.5 times as great as the market value of Shell. In fact, Royal Dutch has often traded at a premium to Shell of up to 20% over fair value. In efficient markets, the same cash flows ought to sell at equivalent valuations. The problem with this example is that the two securities trade in different national markets with different rules and possibly different future restrictions. But even if Royal Dutch and Shell were considered equivalent in all respects, the arbitrage between the two securities would be inherently risky. If Royal Dutch sells at a 10% premium to Shell, the appropriate arbitrage is to sell the overpriced Royal Dutch shares short and buy the cheap Shell shares. The arbitrage is risky, however. An overpriced security can always become more overpriced, causing losses for the short seller. Bargains.